Okay, good afternoon to all of you. Today we are going to discuss the second sources of income, profits and income from property. So before that, I have to mention that I have already given the first individual assignment. Based on the tax environment in Sri Lanka, it is already available in your LMS page as well. And I have given the expected content of the assignment and the uh, formatting of the assignment as well as the marks allocated. Based on the course outline, it has allocated 20 marks. And the assignment will be due on 24th December. Another 4 weeks period is there because 7th week, if I'm correct, I have scheduled on due date would be 7th week. So last week we haven't conducted the lectures, but now we are in the 3rd week according to the schedule. So that 24 December you have to submit. I have already make it available the LMS Dropbox as well on the 24th week, December week. So you can upload your assignment. It's an individual assignment. Okay. Then we'll move to the today's topic, income from property. So property income means week before last we discussed the employment income. Today we are going to discuss the properties which were held. We are having the income, so that we are going to consider what would be the income of the properties which are having. So that property includes land and improvements their own, both we are going to classify as a property. So examples, land, houses, shops, commercial or other buildings as well. So we call it as a land and land improvements as well. Okay, so regarding these kind of properties in the taxation, how we are going to determine the income is today's concern. So that income from property comprises of the following. So either it may be the net annual value, rent income or occupiers income. These are the three main categories that we are going to discuss today regarding the property income. Under the employment income, you have studied the different cash benefit, non-cash benefits likewise. So according to this one, you have to study only the three areas: net annual value, rent income and the occupiers income. First we look at on the net annual value. So the net annual value we call in shortly NAV, okay, is a value ascertained for income tax purposes on the following properties owned by a person. Okay, so it may be a land or land improvements, that may be the buildings as well, and the place of residence where we are in residence place as well. We are going to calculate the net annual value. The NAV of a property is treated as owner's income. Normally, net annual value means we calculate in owner's income is the net annual value. If I am the owner, so that would be the income. NAV would be the owner's income in the situation where the owner occupies it or someone else occupies on his behalf. That means we are going to calculate the net annual value where the owner occupies himself or any other person occupies on behalf of the owner. Sometimes the parents or other relatives, so close relatives, they are going to occupy this property on behalf of the owner. Okay, in such a situation we are going to calculate the net annual value. However, where such properties are used for the purpose any trade, business, profession or vocation, there will not be any income from NAV. So that we are going to calculate the NAV where the owner or any other person on behalf of the owner is going to use that property for their residential purpose. Some of the other persons, sometimes their parents may be used for the commercial purpose or the business purpose that is not relating to the NAV. They have to use it for the residential purpose. Okay. So that's why if you are going to use these properties or for any other businesses or the trade, business, profession or vocation, we are not going to consider, we are not going to determine based on the NAV, any other things are there. Parallelly, you have to consider that one as well. So you have to make sure that whether the owner and the other persons on behalf of the owner is going to use this land or land improvement for the residential purpose, so that we have to calculate the net annual value. Okay. So let's look at on this one. An individual has purchased a house for his own occupation. Determine whether there is any NAV to him as an income source. Okay, because that individual has purchased the house for his own occupation. Own occupation means it is not used for any business purpose, that means a residential purpose. In that case, we have to calculate what? Net annual value. So that NAV of the house is treated as owner's income, subject to some exemptions are there. We are going to discuss it later as well. But the basic concern is if the owner is used for his occupation or residential purpose, then we are going to determine the income from that property by calculating the net annual value. Then, a company has owned a property to be used for as head office building. Still it is a land improvements, but the purpose is the company is the owner of that property, but they are going to use it for the commercial purpose. So, they determine whether there is any NAV on which property, such property as income source to the company. In that case, owner is a company. Whatever the income is relating to that particular company. So in that case, whether the NAV would be the income calculation or any other thing. In this case of commercial building, it is not the NAV because they are going to use this property for the trade or a business. So in that case, we are not going to purely base on the net annual value because the owner is not going to use it for the residential purpose. It is used for the commercial purpose. So then we have to check how we are going to calculate this net annual value. Okay. So rating assessment, we are having the local authorities given the rating assessment if it is in the rated areas, because under the employment income as well we discuss the rated areas and the unrated areas are there. So that rating assessment, and so that based on that you are going to get we are going to allow 25% allowance for the repairs. Okay, the net of that we consider it as a net annual value. So in this question, the rating assessment of the house is 400,000. Can you determine the net annual value of the house? I have to get the straight away. If you can get the 75% of the 400,000, it is the NAV of the house. So that Rating assessment is 400,000. You are going to deduct the 25% on the rating assessment for the repair expenses, that is 100,000. So net annual value would be 300,000. Then the exemptions on the net annual value. So that an individual can claim the following exemption from NAV of a house. This exemption is rating for the individuals, not for the companies, it is for the individuals. So if that individual has a one place of residence, some people have more than one place of residence, but if the one individual has a one place of residence, the NAV of not more than one place of residence owned by and occupied by or on behalf of an individual is exempted from income tax. If the person has only a one residence place and he is occupying or any other person occupied on behalf of the individual, that NAV is the income of that property, so that it will be exempted. Okay, so even though we are having the income, we are not liable to pay on that income. Therefore, if an individual owns one house, the NAV of such house is exempted from income tax. No need to pay tax on. If you are having only one house, there is an income, but you need not to pay any income tax. Okay, this would be the question. An individual owns the following houses. In this case, two houses are there. House in Colombo with NAV is 300,000. House in Kandy with NAV of 200,000. Determine the taxable NAV of such individual. You are straight away given the net annual value. You need not to calculate the NAV of these two houses. So now we are going to determine the taxable NAV. Now they are having is that individual having two houses. If so, what will happen? If the individual has only one house, definitely it will be exempted from income tax. If the individual has more than one house, so you can claim the maximum NAV value as a exemption. So anyhow, for one house you can claim the exemption criteria. So total NAVs for the two houses 500,000. Anyhow, for one house he can claim for this exemption. So in that case, you can claim highest NAV bearing house. Okay. So 300,000. Then taxable NAV would be, you have to pay only the income tax only for the 200,000, not for the total 500,000. So that house with higher NAV could be exempt in the case of more than one house. Then the second exemption, first exemption is the one place of residence held by the individual. The second one is a newly constructed house. Okay, if constructed it prior to 1st April 2008, it is constructed after 1st April 2008, where the floor area of the house does not exceed 1,500 square feet. The exemption is relevant for the year of assessment in which it was completed and 6 succeeding year of assessments. That means, if you are construct a new house and you have completed that house before 1st April 2008, you can claim the exemption on this NAV of the house if that house the floor area is less than 1,500 square feet. Okay, so exemption period is 7 years. 7 years means period, the year of assessment which the house is completed, the year of assessment, and plus another 6 succeeding year of assessments. Altogether, for the 7 year of assessments, you can claim for this NAV exemption if it is a newly constructed house before it has been constructed prior to 1st April 2008, and the floor area should not be exceed 1,500. And the second one is, if it has been constructed after 1st April 2008, what will happen? If the floor area does not exceed 500 square feet for the small scale houses, if the floor area is less than 500 square feet, the exemption will be granted for the year of completion and the next 4 year of assessment. That means altogether 5 year of assessments you can claim for the capital allowance. Exemptions for the NAV. So that make sure that if it is constructed after 1st April 2008, the floor area should be less than 500 square feet. If so, you can claim this exemption on the NAV for a 5-year period. Okay, let's look at this one. An individual has completed the construction of a house on 30th July 2010 with a floor area of 500 square feet. Determine the period within which the NAV of such house is exempted from income tax. If that house is constructed after 1st April 2008, what would be the conditions in order to claim this NAV exemption? The floor area should be less than 500 square feet. Then how many year of assessment can they claim? 5 year of assessment they can claim. So in this case, in which year of assessment they have completed the house construction works? 2010-11. So with that year of assessment and another 4 year of assessments, they can claim for this NAV exemption. Okay. That means 10-11, and for next 4 year of assessment up to year of assessment 14 and 15, they need not to pay the income tax on this house NAV value. Next one is property for sports promotion. Still we are discussing the exemptions on the NAV. NAV of any land and improvements they are owned by a body of person, the primary object of which is the promotion of any sports which is recognized as a sport for the purpose of the Sports Law 25th of 1973 and used for that object by that body if construct on or after 1st April 2008. The previous two exemptions are relating to the individuals. This one is, it may be a body of person. We discussed in the first session as well what you mean by a body of person. If any body of person, they own land or land improvements, they are going to use it for the sports promotion under this sports law, and it should be constructed after 1st April 2008. Okay, so in that case, that NAV value would be exempted. Okay, they need not to, that body of person need not to pay the tax, income tax on this NAV value. Then next one would be place of worship. The net annual value of any place of public worship and its premises administered by a charitable institution is exempted. So in your syllabus you are having the charitable institutions as well, charities. So you are going to consider if you are that charitable institution having a public worship places, so that in that case the NAV value would be exempted. Next one would be the rent income. First one is a net annual value. That means if the owner is occupied that property is for the residential purpose, or on behalf of himself any other person will be occupied for the residential purpose, then in that case the owner's income would be the NAV, and NAV, if that person is going to use it for the any other business or commercial purpose, NAV is not the income in that angle. So we are going to calculate the NAV straight away based on the rating assessment. Then you can claim the 25% of the rating assessment. Net value would be the net annual value. And some of the exemptions we have already discussed for the individuals and the other body of persons. The second one is an income of an individual by letting a property is a rent income. Now we are having the property, it may be a house or any other building. Now we are not going to use it for our purpose. We are going to let it out for a third person. So in that case, NAV is not the owner's income. In that case, you have to calculate the rent income. Okay. So an individual received the rent income from renting a house in Colombo. Will there be NAV source for any house for the tax purpose? Still, he is an individual. He is having a house. Normally, houses are used for the residential purpose, but he has let it out for the any other person. The house is in Colombo area. Will there be any NAV source for that house for the tax purpose? In that case, we are not going to purely base on the NAV, because in that case, owner is not going to use that house for his occupational purpose or the residential purpose. So he will be liable only on the rent income. That means we have to calculate the rent income. NAV of that house will not be treated as the owner's income, because the owner is not going to use that house for his residential purpose. Then that means when the property we are going to let it to another person, rent it out, then we have to calculate the rent income. Then how we are going to calculate the rent income? This would be the formula. Before ascertaining the rent income, first it required to compute the amount of net rent. First you have to calculate the net rent. Okay, the amount of net rent is a gross rent after deducting some there from the allowable expense as shown below. So first you have to, when you are rent it out to another person, definitely you are having the monthly rent fee. Okay, so within that tier of assessment, the gross amount you have received as a way of rent. So you have to get the total gross rent received by the owner. From that you have to reduce the rates borne by the owner. Normally, owners are paying the rates for the municipal councils. So, for that tier of assessment, you are going to deduct this rate. If these rates are not borne by the owner, he cannot claim. Let's assume that tenant is paid that rates. So, we are calculating this net rent is the perspective of the owner. In this case, if the owner is not going to pay that rates, instead of that the tenant is going to pay, the owner cannot reduce this amount because he is not paid that amount. In that case, you are not liable to, you cannot deduct this one. If the owner pays this rate, he can claim as a expense. For that net amount, you can claim the 25% allowance for repair. If that repair is actual amount is, it may be less than or greater than, but this 25% you can claim whether it is greater than or less than. If it is actual payment, sometimes it may be greater than, but even though it is greater than, you cannot claim the actual one. Only the 25% on this net value you have to claim. Okay, so that would be the net rent. Still, we are not going to calculate the rent income. Still, you are calculating the net rent. Okay, shall we calculate the net rent for this information? An individual has let the property for whole year of assessment for 15 and 16 for a monthly gross rent of 50,000. He has paid actual rates of 40,000 and has incurred repair expense of 80,000. Determine the amount of net rent. Shall we calculate the answer? Okay, so first you have to get the gross rent received by the owner. 50,000 into 12 months we have, because he has given it for the whole month's year of assessment. Then rates borne by the owner. In that case, they are directly mentioned that the owner has paid 40,000 amount of rates for in this house. So that net amount would be 560,000. For that net amount, you can claim for the repair expense. So it is 140,000, even though that the actual repair cost is 80,000. So you can claim more than that, 140,000, up to 140,000 you can claim as a repair expense. So that net rent is 420,000. The note is he is entitled to claim the repair allowance of 25% as he bears the repair expense. So this would be the net rent, 420,000 would be the net rent. Now we are in, if the house is rented out for another person, first you have to calculate the net rent. Okay. After the computation of the net rent discussed above, the next step is to determine the rent income. Okay. Still we haven't determined the rent income, but the actual income by letting out the properties to another person would be the rent income. Okay. It is the rule that the property minimum amount to be declared as a rent income should be an amount equivalent to the NAV of that property. Normally, the rule is that, governing rule is that whatever the property, minimum income should be the net annual value of the particular property, because the net annual value means what? Net annual value means what? If the owner occupies by himself, okay, without gaining any additional income, he is going to use his residential purpose, his occupation. So that would be the minimum income of whatever the property or the land and land improvement. So So you have to compare this minimum income of that property with the net rent. Net rent we have already calculated. That means if the property has been letted out to another person, so that would be the income. Then you have to compare it with if it is the property, we are not going to use it for any other purpose, but if the owners occupies that one, what would be the minimum income of the property? Then you have to compare this minimum income with the net income, net rent. Okay, it is required to compare the amount of net rent with NAV, where the net rent is greater than NAV. If the net rent is greater than the minimum income of the property, that is NAV, the net rent is treated as a rent income. So that would be the governing rule. This case is emerging where the property is not going to use by the owner. Instead of that, the owner is going to rent it out for another person. In that case, first you have to calculate the net rent. Net rent means you have to take the gross rent received by the owner, and then you can claim the rates borne by the owner, and then repair 25% of the repair expense. So that would be the net rent. But straight away you cannot take that net rent as a rent income, because there is whatever the property, there is a minimum income level. So then the minimum income level means the net annual value of the property. You have to compare the net annual value of the house with that net rent. If the net rent is greater than the NAV, that means the minimum value of that property, no any issue, you can straight away take the net rent as a rent income. Okay. Let's look at this question. An individual has a house in Colombo and has given it on rent for a monthly rent of 60,000 for the whole year. The rating assessment of the house is 400,000. He has paid rates at 20% on the rating assessment. So now we have to determine not the net rent but the rent income. So when if you are asked to calculate the rent income, that means first you have to calculate the net rent, then you have to calculate the NAV, then you have to compare. Okay, first we calculate the net rent, then we compare it with the net annual value. Okay, so gross rent, it has mentioned that monthly rent of 60,000. Okay, so that 720,000. Then The rates are borne by the owner, that individual. Normally rates are, we are going to pay it based on the rating assessment. So that rating assessment of the house is 400,000 out of 20%. 80,000 would be the rates. The net value would be 640,000. So on that net value we can claim 25% allowance for the repair, that means 160,000. Okay, then we can calculate the net rent for that property is 480,000. But this 480,000 we cannot straight away take it as a rent income. So there is a minimum value for minimum income for this property. The minimum income would be the NAV of that particular house. So how we are going to calculate the NAV? Next, that would be the problem. We have already studied that one. From the rating assessment, we can claim 25% for the repair expense. If not, you can take the rating assessment is 400,000, straight away you can take the 75%, so that net annual value would be 300,000. Now we are having two figures. Net rent is 480,000. Net annual value is 300,000. That is the minimum income of that property. So in that case, net rent is greater than the net annual value. The net rent is greater than NAV. The computation of net rent is acceptable. That means we are going to consider the net rent as the rent income. So that the rent income would be 480,000. Next one is, if the net rent is less than NAV, what will happen? Okay, before that we discuss, if the net rent is greater than NAV, we don't have any issue. You are going to take the net rent as a rent income. Now the net rent is less than the minimum income of that particular property, that is the NAV. The amount of net rent is less than the NAV. The computation of net rent may not be accepted. We cannot take it as a rent income because the net rent is less than the minimum income of the property, that is the NAV. In such a case, the minimum amount to be declared as the income of the house is amount equal to NAV. And there is an occupier's income to the tenant. We'll discuss it later. Sometime there will be, in this net, if the net rent is less than NAV, sometime there will be the occupier's income. Occupier means the tenant perspective. So we'll discuss it later. Anyhow, if the net rent is less than the NAV, we are going to consider the net rent income as the NAV. Okay, the owner will be taxable as rent income for the amount of NAV less than the occupier's income. If the net rent is less than NAV, in that case net rent you cannot take it as a rent income, so that you have to take the NAV as the rent income. But before that you have to check whether there is a occupier's income. Sometime it may be occupier's income, sometime may not. If there is a occupier's income, you have to calculate that one and you have to deduct that occupier's income from the NAV. For the net amount, owner should have to pay the tax. If there is a no occupier's income, then for the total NAV value, owner should have to pay the income tax even though this property is rented. Normally, we are going to pay the taxes for the rented properties on the based on the gross rent, but in this case it is less than the minimum amount of the property. So the NAV would be the rent income. So before considering it as a total taxable income, we have to check whether there is a occupier's income. If there is occupier's income, you have to calculate it and remove from that amount from the NAV. For the net balance, you have to pay the tax. Assume that the theatre checker 37, the gross monthly rent is 30,000. Can you calculate the rent income? Now, the previous one, that means the individual has a house in Colombo, has given it rent for monthly rent of 30,000. Now, not the 60,000. For the whole year, the rating assessment of the house is 400,000 and he has paid rate at 20% on the rating assessment. Then can you calculate the rent income? Okay. So you have to calculate the net rent again. Gross rent now 30,000 into 12 months, 360,000. Rates are not changing because we have to pay it on the based on the rating assessment. It is 80,000. Now the net amount would be 280,000. On that you can claim 25% for the repair. So it is 70,000. So net rent would be 210,000. At the meantime, you have to calculate the net annual value as well because you have given it for the for rent purpose. So that NAV is based on the rating assessment. So it is still 300,000. Now we have to compare it with the rent income. Now the net rent is less than the net annual value. So what will happen? That means by letting out to that property, we are having the income which is less than the minimum income of that property, that is NAV. So that the amount of net rent is less than NAV and therefore the NAV of the house 300,000 is the income tax liable. That would be the liable income tax. Still we cannot consider it as a total NAV because sometime there will be the tenant income or the occupier's income. So you have to consider it, calculate that tenant income. If there is a tenant income, you have to reduce that. Let's assume that it is 20,000. So you have to deduct this 20,000 from the 300,000. Then your owner's property income now would be, the rent income would be not 300,000, 280,000. At the moment, we are not going to calculate the occupier's income. Still, we have to discuss that one. For in this case, if the net rent is less than NAV, the owner's income or the rent income would be the NAV, not the net rent. Okay. Next we are going to discuss some of the special things. Okay, under the following circumstances, the amount of NAV may have to be adjusted since the computation of net rent is not for the whole year of assessment. So, in this case, when we are giving our properties for the rent out for other persons, these special situations will be there. Okay, because we are not going to use it for our purpose. Some certain months for which the property sometime may be vacant. We are not in a position to give it to the tenant for full year. Sometime 3 months or 6 months time house will be vacant, or some situations will be there. Certain months which rent could not be recovered. Sometime tenant will not give the rent values for the owner. Sometime it will be recoverable. So in that case, even though we have given that our house to full year of assessment, but we are in a position to collect these rent values for some maybe 10 months or 8 months time period. For the other months we cannot collect. In such a situation, how we are going to calculate this property income? Okay. Let's look at this one. A house in Bambalapitiya rated by Colombo municipality at rupees 60,000 and rates at 30% is rented out at a monthly rent of 10,000. The owner bearing the cost of repairs. The house was occupied for the owner whole year, but due to various problems, the tenant did not pay rent for 3 months. The owner could recover rent only for the 9 months. Then the owner's income would be what? Is it NAV or a rent income? Owner's income would be, is it NAV or a rent income? It's a rent income because anyhow he has given it for the renting purpose. Okay, in that case you have to calculate the rent income. In order to determine the rent income, before that you have to calculate what? Net rate. Okay, when you are calculating the net rate, now even though you are given it for the whole year of assessment, now we have received only 9 months rent only. So in that, when you are taking the gross rent, you have to take only 9 months rate. Okay, can you calculate? Okay, this would be the answer. So first you have to calculate the net rent. Okay, when you are calculating the net rent, now you can collect only for the 9 months rent because that would be the actual amount you have received. So 90,000. From that you have to deduct the rates. Rates you have to take the full year because you have given it for the occupational purpose, but due to some issues you are not in a position to collect the rent income only, so that you have to pay the rates for the whole year of assessment. The rating assessment would be the 60,000, so rates 30%, so 18,000 would be the total rates payment. On net amount 72,000. On that 25% for repairs you can claim, that is 18,000, so that net rent would be 54,000. Still you cannot determine that net rent would be the rent income, so you have to calculate the NAV of that particular house. Okay, house, the NAV would be, rating assessment is 60,000. You can claim 25% for the repair, 15,000. NAV for the full year is 45,000. But the net rent you have calculated only for the 9 months, so that you have to convert the full year 45,000. How many months? Then for the 9 months, what would be the minimum income of the owner? So that it is 33,750. Then you have to compare net rent for the 9 months with the NAV for the 9 months. So that in this case net rent is greater than the NAV for the 9 months, so that rent income would be the net rent, that means 54,000. Okay. Next one. He has another house in Kandy with the rating assessment of 150,000. Rates paid at 20%. He has given his house on rent at the month rent of 20,000 in August 2015. And it was vacant from April to July 2015. So then you have to calculate net rent for the rent income of the owner. That means again the owner is not going to use it for his occupational purpose. So instead of that he has given it for the rent purpose. So that, but in this case for one, from August onwards they are given for the renting purpose. April to July months it is vacant. That means for the net rent, gross rent received only from August 2015 to 31st March 2016 only. Then you are paying the rates. For the vacant period you need not to pay the rates. So in that case rates also you have to convert it for the occupational period. Because April, May, June, July, 4 months you haven't used for the occupational purpose. So in that case, these 4 months time you need not to pay for the rates for this tax purpose. Okay. So can you calculate the rent income? Okay. So rent income, rent received, it should be the rent received, gross rent received, 20,000 into 8 months because it is vacant for 4 months time period. So total rent received by the owner would be 160,000. Then rates, based on the rating assessment 150,000, you are going to pay the 20% as the rates. Only for the 8 months you need to deduct because for the other 4 months period it is vacant. So 20,000, the net balance would be 140,000, 25% for repair on the net amount, that is 35,000. So that net rent would be 105,000. Okay, again you have to calculate the rating assessment of the house. So that rating assessment, NAV of the house, the rating assessment is 150,000, 25% repair 37,500. So for the full year NAV is 112,500. Again you have to convert it for the 8 months. Okay, because it is vacant for the 4 months time period. So the NAV would be 75,000. Then you have to compare net rent for the 8 months with the NAV for the 8 months. So minimum amount would be NAV, so that net rent is greater than the NAV. So rent income would be 105,000. Because the rates in that case we haven't given it for the full year. 4 months time period the house is vacant. In that case you cannot claim for the whole year of assessment, only use occupied period you have to claim for the tax purpose. Okay. The previous one, they have used the residence for whole 12 months. The problem is, due to the tenant's problem, we are not in a position to collect the rent income. Okay. Next one, computation of rent income for the furnished houses. Some are there, so that they are going to give the houses with the furniture, like in the employment income as well. You have studied that a house with the furniture and without furniture you can obtain. So in this case as well, now you are having the house or property with the furniture, you are going to give it for the tenant. Furnished holiday bungalows in which the owner resides periodically will not be regarded as a vacant if not let, will be considered as occupied by him. The minimum liability will be the NAV. Sometimes the holiday bungalows owner periodically use for his sometimes seasonal periods, sometimes school vacations, they are going to use it for his residential purpose. So other periods for some businesses they are going to use. Okay. So in this case, if the period which the owner is not going to occupy it, we are not going to consider it as a vacant period. Okay, in that case, if a furnished house is rented, the rent income is composed based on the unfurnished rent. Without furniture, what would be the income? That is the NAV of that house, and profit from furnishing. Both things you have to calculate. Okay. This would be the calculation for the furnishing benefits. The rent received, so you are having some amount. To that you have to add the rental value for the period occupied or deemed to be occupied by the owner. That means within which period the owner is going to use. the rental value, and from that you have to reduce any expenses like agent commission, because for the other period you are going to use for the business purpose. Okay, so in that case sometime you have to pay it for the agents for the commissioning in order to take the businesses, and expenses for upkeeping of the furniture, because with the furnitures now we are going to give it for the rental purpose. Then rental value for the full year, then profit from furnishing, that would be the profit from furnishing. Can you calculate the answer for this one? A businessman resident in Kandy owns a furnished bungalow in Bandarawela, which he generally occupies during the season April to May for 2 months. 1 month is kept vacant for cleaning of before he and his family occupied it. The balance 9 months he rents it out at 5,000 per month. That means owner is going to occupy it only for the 3 months, but 1 month is vacant for the upkeeping of the furniture. Okay. The balance 9 months is going to rent for another person. The rental value of the bungalow based on the rating assessment of the Bandarawala Urban Council 30,000, and the council rates are 10% of the annual value. Broker's commission is 2,500. Upkeeping furniture is 2,400. Okay. So you have to calculate the furnishing benefit as well as the unfurnished benefit.